Then let's go into the second service that we added in Q2 2020, and that's lending. Uh, Lending was added because at that point, mainly Bitcoin, which I mentioned, is proof of work, right? So you cannot stake it. You would have to do mining. Also, Ethereum back then was only mining. And obviously, dollars, in this case, stable coins. For those of you that don't know what stable coins are, stable coins means there is a backing by a company that promises, and you have to trust that promise, right? And again, especially Tether, many times very questionable how good is their promise. USDC is the US dollars backed by Circle. Coinbase is also part of that, a bit more trustworthy for many users. But so basically, instead of trading dollars, you trade tokens that represent those dollars. And they always called USD and then some ending depending on whatever firm is doing this. You will also find, for example, BUSD, it's from Binance, or there's PAX, which is also another stable coin. And so obviously Bitcoin, Tether, dollars, very, very big kind of market, but you cannot really get cash flow from staking because this doesn't exist. So we do this via lending. And the returns are way lower in that than staking. And I want to run you through how that works. So a bit of a different model. So that's number 2. That's lending. And the way this works here, we started this in Q2 2020, and that was actually the model that got us cash flow positive. So that was the key. So the staking, also when you look at our user numbers, I mean, it was quite exciting for people, but at the end, it was not super revolutionary. So the real key that really got us cash flow positive and really kind of got us traction was lending that we started about a year afterwards. We had to solve a couple of things from a regulatory standpoint, and I'll walk you through with those. So obviously, one of the key regulatory things is we don't want to be an exchange. We want to be a technical custodian. We want to be a technical facilitator. And that is very important. On the lending side, there were a couple of other issues. For example, a concept called you don't want to be a fund manager. So the person always has to be actually in charge. So the person takes the financial risk. The person has to be the decision maker. So everything there. It's not that we go and we make decisions for the customer. That's very, very important, all of that. So how does this work here? So the people have Bitcoin, ETH, or USD in form of stablecoins. They use Cake as a tech intermediary, but the funds actually are still responsible by the customer. So we just forward that. So that's Cake. And we forward that to institutional partners. And in this case, it's Sparrow. They are a large partner here in Singapore, and they are actually backed, or they have an insurance by Signum. Very, very large here, owned by the Far East family here. So very, very large. And basically the idea here is, and one thing we're going to work with them is to get way more transparency for our customers from their end. This was also something that we always wanted to have so that customers can actually see what's happening. But what is happening, let me explain it to you, is they then go mainly to exchanges. And this is something that happens in stocks as well. You could do this with Tesla. You could do this with Apple. You could actually do this with any share, with anything. You could even do this with gold. It doesn't matter. It's a very prominent, like it's a very well-known cash flow strategy. And the way this works is you kind of use this for two things. You lend this to either people who go and use leverage, and your part is always used as the main principal. So in theory, and that's key, in theory, your fund should never be lost. And again, it's very, very unlikely that it happens. On top of that, we have an insurance that makes sure the funds, in this unlikely scenario they do get lost, they actually have to step in. But it's very unlikely it ever will. That's, for example, because you need to have margin. And so if you've ever done leverage trading on exchanges, you do need that kind of margin. And the other thing is they use this for short sellers. So short sellers borrow that. And so that is how this then works. And so these people, if ever you have done leverage or short selling, you pay a commission to the exchange. the exchange takes their cut and then pays a commission to these super large aggregators, and then they pay a return to the customer, and then obviously here Cake takes our cut. Now here the cut is way more variable because it depends on actually weekly returns. So every week, every Friday, we actually settle those batches, right? And this is run in batches. Mostly Ying and Bettina have to do that. And so every week we actually get a return from them plus appetite. So how much do they want? So it's not different to staking. Here, everything happens from Friday, always 4 weeks. We do have 4 batches, so actually a new batch starts every week, but it always goes 4 weeks. And there's always a cap, there's an appetite, because they say, you know what, we don't need more than that. Exchanges are not asking for more than that. And the return fluctuates. It goes up or down. And if the return goes up, we don't always forward that to the customer. We just take a little bit more, or the return goes down, then we just make a smaller cut, and we still try to pay the same amount to the customer. Just every once in a while, I think in our entire history, we had to adjust the rates twice. So we always try to do this really well. But sometimes the rates go so low for such a long time that we cannot cover those losses. And then we just have to lower the rates. We had this beginning of August 2021, where we actually had to lower rates. Not because we wanted to, but really because there was just not an option for us. Obviously, on the lending side, it's a bit different to the staking side, because here it's not the blockchain that generates those returns. Obviously, it's the entire system that does that. It's the same as in stocks, right? So if you were an Interactive Brokers, and you could do the exact same thing. Actually, Interactive Brokers asks you if you want to do that. You could either do this as a standard or you cannot. So either where you just lend out these your stocks. There is always a super slight risk, right, that the exchange screws this up and your funds are gone. To be honest, the risk is super, super, super tiny. On top of that, we do have Signum in that case, Signum Capital. But at the end, the customer has a bit of a different risk in comparison to staking. That one has to say that. One key thing, we do call both products low volatility though. And the reason why we call them low volatility is because there's always only one coin involved. And you will see what I mean with that. In both products, the lending risk is super, super, super tiny. It's not zero, but it's super, super tiny. So actually sometimes with some of the size of the blockchains, right, one could discuss is Dash, for example, as a blockchain, is staking there safer than lending Bitcoin, simply for adjusting certain risks. So I actually think it's very, very similar in that sense. But one reason why we call both products here low volatility is because you always have only one coin. And in theory, you get your principal back. If you put in a Bitcoin, you know you're going to get your Bitcoin back plus a return. Yes, in dollars, this thing might fluctuate, but the coin itself, you know, you put something in, you will get the coin back plus a little bit on top. And it's the same on Dash, it's the same on DeFi chain. So the calculation here is mostly towards dollars. You don't have to worry so much about the actual, like getting fewer coins back. This is very different in the third product that I'll talk about, but just for the kind of general sense here, so that you understand that. So a bit different here on the lending side. It always runs 4 weeks. We are looking into having a so-called running rate. Many platforms do that. At the end, they still have those batches. They just don't show them to their customers. There's way less transparency that way. And so when you look at other lending platforms, be it BlockFi or Binance, they're way less transparent, and there's a lot of criticism there as well. Also from regulatory side, you can look at BlockFi. BlockFi just recently got into major trouble from a regulatory standpoint. We should be relatively safe in that regard because we're extremely transparent. We tell our customers everything. We tell them how everything works. And we want to add here additional transparency that Sparrow and Signum actually show way more where the funds are, what the funds are doing. This should give quite a unique insight for customers. This is not going to be something that I'll have ready tomorrow, but we actually have another meeting with Sparrow about that next week to really increase that. Adding more coins here is a bit more different than on the staking side. So I would probably be a bit more hesitant in adding more coins here. For the very simple reason, because it always needs a partner, it always needs someone to help out. So yeah, that's just kind of a bit of a idea here. then yeah, let's just quickly look at the website so you can see what this looks like. So here at the bottom, for example, you can see the batches, and yeah, you can see the returns here. So yeah, and people can actually read all the details here. Yeah, for all their questions with examples and so on.